Chris.
Morning, Connor. How are you? Interesting weekend, eh?
Yeah, so it's Monday, March 13th.
Mm-hmm.
It's about 11 o'clock Mountain Time this morning. It's been an eventful few days in the markets, huh?
It has been.
So we were looking over your weekly commentary, your and Shweta's weekly commentary, and you called this morning and said you'd like to make sure we have a unified voice on this to talk about the events and what's been going on over the weekend. Turns out we don't have a unified voice on this. Is that fair?
That's fair, and that's good, because one of the things we base this firm on is fundamental, open, transparent discussions, and that's what we're having. And I think it's good for our clients to know we have those on an ongoing basis.
Absolutely. So how would you summarize this issue that you and I disagree about this morning?
Well, I feel that the collapse of SVB, Silicon Valley Bank, and Signature Bank, which was more crypto related, I think those are isolated incidents. When you look at the reporting on Silicon Valley Bank, they suffered two problems. First of all, their depositor base was not diversified. They had a depositor base that was built on venture capitalists, tech, and startup firms. And those firms are all correlated, so that when one part of their investor base needs money, needs liquidity, odds are they all do.
So no disagreement yet, by the way, no disagreement yet. Continue.
And so what they had was they had an investor base that needed liquidity all at once, plus an investor base that was very attuned to social media and were able to feed into each other's paranoia about Silicon Valley Bank. The second issue go ahead.
To pause, what bank in the world doesn't have a depositor base that isn't finally attuned to social media these days?
No bank does, but also many major banks have a well-diversified depositor base,
sure,
representing many industries with divergent needs for liquidity, or different needs for liquidity. The other problem that Silicon Valley Bank had, in their investment portfolio, they had very little credit risk. But there are two types of risks in a fixed income portfolio. There is credit risk and there is duration risk. Silicon Valley Bank had no credit risk. They were invested in treasuries and high quality mortgage-backed securities, but they had tons of duration risk. And one of the problems is when you segregate the investments in a bank, these were all in the bucket called held to maturity. They don't have to be marked to market until you sell one security from that bucket, and then the entire bucket must be marked to market on that day.
So once again, no debate there either, and Silicon Valley Bank looks worse on many of those, depositor concentration and duration mismatch. But much like the social media, I'd ask, what bank in the world doesn't borrow short and lend long?
Many banks do, but when they borrow short, they borrow from a diverse spectrum of clients who do not have correlated cash needs.
So the fine point on our disagreement this morning was whether the FDIC and the federal government took the right action over the weekend in guaranteeing deposits over $250,000 for Silicon Valley Bank depositors.
When we closed business on Friday, Shweta and I have taken the position and continue to hold the position that what has happened at Silicon Valley Bank is isolated. It is not a systemic risk to the banking system. It is an idiosyncratic risk to Silicon Valley Bank. And I'm using all my big SAT words today.
And how quickly, Chris, can one isolated issue spread and create contagion across the system? So to me, I think there is no doubt that the FDIC took the right actions over the weekend, and I worry that it wasn't even enough. I am perplexed to see regional banks trading off today after the government has said your deposits will be safe, they will be safe. The only risk to those regional banks anymore is a run. The FDIC has said you don't need to run on the bank. We'll make sure your deposits are safe. The stocks are still down. I see a vicious cycle there that could do real harm across our system, even after the FDIC is there.
My disagreement with you is that what the government and the FDIC did this weekend was to create an isolated, idiosyncratic, individual bank risk and turn it into a systematic risk. Because if I'm a CFO someplace and I see the government has just guaranteed all depositors money, my first thought is, what aren't they telling me? Is this a bigger problem than I suspect it is? And runs on banks are all psychology.
Yes,
okay?
exactly. So you need to shore up confidence.
And what the government did does not shore up confidence, because it said it's a problem for all regional banks, rather than saying, no, it's a problem for this individual regional bank that screwed up. Let's talk about how much they screwed up. Officers in that bank sold stock Thursday. Do you think they knew what was happening? That officer base took their bonuses Friday. Is that good management?
No, that's terrible. And equity shareholders have been zeroed out.
Fine, that's the game.
Yeah.
You know, no risk, no reward.
I just think protecting depositors makes a lot of sense when you're trying to instill confidence in the banking system.
Okay, so what is the biggest governor to taking risk in our business?
The risk of loss over the long term.
The risk of loss. So what has the FDIC just done? It has taken away the risk of loss to depositors. Okay? And in effect, they're telling bank management, your depositors have no risk of loss, keep borrowing short. And oh, by the way, lend the hell out of anything you want to lend out. Take on duration risk or credit risk, because there are no consequences for you doing that to your depositors.
Here again, you're suggesting that there haven't been consequences for the management of Silicon Valley Bank, for the employees of Silicon Valley Bank, for the investors that have exposure in Silicon Valley Bank stock or debt securities that have now been harmed.
Right now, every depositor knew on Friday that they were only insured up to $250,000. So they made a bet on Silicon Valley Bank to invest more than $250,000. The depositors have now, they don't have the consequences to that bad decision. That has been taken away by the government. It is a nanny state at the worst. And I guess, you know, the great thing about a nanny state is when the crisis is yours, a hug from the nanny state feels good. It's not good long-term policy.
That may be. I still don't think, over the weekend, I think actually the FDIC was absolutely in the right.
But the one thing I think our clients should feel good about is that we have this debate. And we have this debate on any number of issues going forward. And that makes for better investment decisions.
And however we get this up, we're going to have to take some votes in the comments about who you agree with, Chris or I. All right, thank you, Chris.
Thank you, Connor.